Module 11 covers long-term contracts, not just construction, but any sort of long-term contract. And there's a variety of companies in different industries that will offer a long-term contract on goods or services that they are providing. Construction is one that I refer to a lot simply because it is, perhaps one of the easiest ones for students to wrap their heads around. Of course, we're also, thinking of provision of R&D contracts over time, the provision of technological services over time, the provision of defense contracting, which tends to be long-term in nature. All these items, all these industries would use long-term contracts. And so we have a very special way of accounting for that, and that is what we call the percentage of completion method. It is the method preferred by the AICPA when all four, there's no longer four conditions, but when all three conditions are met. Estimates of progress, revenues, and costs are reasonably dependable. So we have to be able to estimate our progress to completion, estimate the amount of revenue that we plan to get on the total contract, and also how much we've spent in any given time. The contract clearly specifies enforceable rights. This is something that we've identified in the prior new revenue recognition, where we have specified rights of the buyer, specified rights of the seller, and also we have one of the three conditions for which revenue over time is met. Again, refer to Module 9. Remember that there were a few specifications where we are providing the customer for something they're able to consume as we complete it. The customer has ownership of the asset as we complete it, or the buyer and the seller have enforceable rights where the seller is able to bill the buyer over time and receive payment for the progress to date. The completed contract method is a second sort of method and should only be used when one of the following is present. That it's not possible to meet the conditions listed above, and none of the three conditions are met for recognition of revenue over time. Those three conditions, again, were the ones in Module 9. Okay. So we're going to look at both methods when, again, preferred, not preferred. So when you can do this, you do this. When you can't do that, then you do the completed contract method. So there's a variety of new journal entries, but more so new accounts that you're going to have to learn. Journal entries aren't a problem after you start learning accounts, or I hope at this point they start to become less of a problem for you to master. You really need to understand the new accounts, and when you understand an account, it's easy to journalize the item. So revenue is going to be recognized on the basis of construction progress. It's called the cost to completion basis, right? Costs relating to the contract plus gross profit to date are accumulated in what we call a construction in progress account. We credit whatever assets are used in the construction progress. So in this case, we debit construction in progress, and we credit cash if we spent cash, or if we had materials on hand that we used up, we would credit the materials account. So what we're doing here then is building an asset with the use of an asset. The construction in progress account, or the construction in progress, will be a current asset to the seller who is constructing. And even if, we're talking about a long-term contract, but remember that current assets are defined as the next year or operating cycle, whichever is longer, right? So in the case of a construction contract, then we're going to have the operating cycle be longer than a year, and the operating cycle is basically defined by all of the investments that they put into a construction project up to the point that they sell it then and turn it over to the buyer. So that fits within the operating cycle. So the current construction in progress will always be a current asset. When we bill a customer for any amount of the costs, we debit accounts receivable, then credit an account called billings. So this is a new account. This is a contra asset, and it reduces the value of our construction in progress account. So now we have two new accounts. I'll just shorthand it CIP, Remember, the CIP is a current asset, debits to increase it, credits to decrease it. And then we have billings now, which is a contra asset account. So it works in opposite of the CIP account. If we net these two accounts, so say this is a $10 balance in CIP and this is an $8 balance in billings, then we have a net asset because CIP was greater than billings. If the credit balance of billings is greater than the debit balance of the construction in progress, then we're going to have a net liability because the CIP debit balance was not enough of the billings. The way to think about it is, we've billed more than we've actually built, and that creates a liability or a contract liability. Or we've built more than we've billed, so that creates a contract asset. Right? We'll get more into the contract liability and contract asset, but again, you need to know these two accounts and how they work with one another. So anytime that we bill, we debit accounts receivable, credit billings. So this is going to be an increase to an asset, and this, because we are increasing a contra asset, decreases an asset. So we've had no net movement of assets on either journal entry, just assets for assets. And again, when we collect billings, that's going to be a debit to cash and a credit to accounts receivable. So once more, we have an asset for an asset exchange. Now, that's all the balance sheet stuff that happens in long-term contracts, right? If this is, a research and development item, then we would just say, research development in progress. Revenue is recognized each period based on the percentage of the total revenue will be recognized on contract. So basically, we'll look at how far we've gotten along by our percent of completion. If we're, say, 40% complete in a particular period, then we could recognize up to 40% of the revenues in that period. And we'll talk about that more below. Right now, I just want to lay out the journal entry, which is pretty straightforward. You're going to record two things, and then you'll have a plug. So you're going to be able to figure out how much revenue you made on the contract. That increases net income. You're going to determine how much of a cost of construction you've had. That decreases net income. And then your construction in progress account is the current asset account, so that increases an asset. It represents gross profit, right? Because why does it represent gross profit? Well, because the credit amount of revenues less the debit amount of expenses gives me the gross profit. Right? In this case, then it's the plug value that makes this guy balance. Revenues less expenses equals gross profit. Remember that every accounting journal entry can be re-expressed as an accounting equation where we have gross profit plus expenses equals revenues, or flip it around, revenue less expense equals gross profit. So this is my plug. And it goes into the construction in progress account, which is important too. And that is why sometimes, or you'll see it labeled on some balance sheets, not construction in progress, but it will be called cost and profit in excess of billings. It's just an extremely literal labeling, right? Because all our costs, if you recall, all our costs, our cash and our materials go into this account as a debit. So it tracks all our costs over time. And all of our profits, now our gross profits, go into this account as well. So it's our cost and our profits. And then when we go to report it on the balance sheet, recall we have to consider billings, which is a contra asset that reduces the balance. But as long as there's cost and profits in excess of billings, you'll have an asset. If there are billings in excess of cost and profits, then you have a contract liability. So let's talk about how you actually measure the revenue on these things. What you do, of course, is to get a determination of how much of the job you've actually completed. That would be the total costs incurred to date divided by the most recent estimate of total costs. So this is going to be, this most recent estimate will involve any costs that you've incurred to date plus the costs to complete, because that would be your total cost. Then when you have what percent of the job you've completed, you take that percentage of completion, multiply it by the total revenue that you estimated. This is just going to be the contract price. You know, how much is the seller guaranteed to recover when they finish the building? And that gives me the revenue to be recognized to date. Okay. Because then we have to take the revenue that's recognized to date, subtract off any revenue that's already recognized, and then we get the current period's revenue. So let's look at an example of this, and it should hopefully clear up the process. Now, this is, again, a very procedural thing in that you're going to want to have a pretty lockstep method of laying out your work so that whenever you actually go to do this, you're not sort of lost and you don't have a plan of attack, and also so that you're organized and I can follow your work, which is very important to getting points. So again, we have the details for a long-term construction project. We have the contract price. That's how much the buyer will be awarded at the end of the contract. We have a few estimates, current year costs, costs from prior years, and then that gives me the total costs to date, right? Anything I've actually spent in the current year plus anything I spent in the prior years will give me the total amount that I spent to date. And then I have the amount that I would have to spend in order to complete the project, which could vary over time. Now, the cost to date plus the estimated cost to complete would give you the total costs in any given time period. Then I also have billings and collections per each year. So take each piece of data a little bit at a time. Don't become overwhelmed with these items, as it's easy to sort of lose your way when you just look at the whole thing. So in 2014 then, I would have my costs to date, right, $150,000. And then I would put that over the total costs, the total estimate of costs to finish this contract. Well, I have $150,000 to date, and then I estimate that I'm going to have to spend $450,000 more in order to complete the contract. And so my total amount to complete, including those to date, becomes $600,000, which is 25%. So I've completed 25% of the job as long as this estimated cost to complete holds. I multiply that percent by the total contract price, right? So this is the total amount of revenue I expect to recognize, but I can't recognize it all. I can only recognize the amount for which I've earned my percent to completion. So that comes out to $168,750 of revenue earned in 2014. You can go ahead and write that here. And then in order to determine my gross profit for this date, I would subtract off whatever current year costs I have. So my $150,000 were the costs in 2014, which then gives me $18,750 of gross profit in 2014. And then I would recognize that all of those entries with journal entries, I will go over the journal entries in not a comprehensive problem, but a problem that we will look at in just a bit. But right now, I'm just focusing on your ability to compute the revenue, to recognize, and then to determine the gross profit on the contract. In 2015, We now have current year costs of 287,400. We had 150 from the prior year, so to date, we spent 437,400. So that's my cost to date. Now the costs to complete would be 437,400 plus the amount that I estimate I have to spend in order to finish the job. Now notice that in this case, my estimated total costs have changed slightly. In 2014, my total costs were estimated to be 600,000, but now they've risen 7.5 thousand to 607,500. Now, this is why you can't just take an estimate of the amount that you've completed since the last time. And this is why you have to think of the total cost to date versus just the incremental amount that you've earned, or the incremental amount that you spent divided by the costs that were remaining. You know, what I'm trying to say is don't shorthand it, because you could get caught. The only time that shorthanding and looking at the change between years will work is if this total costs stays constant, and you can't be guaranteed that it will. So be careful with it. Don't shortcut it. Make sure you do every step. I know you're going to think, oh, this is redundant. Why am I continuing to do the entire thing when I can use math to shortcut it? And you can only use math to shortcut it, in certain cases. So, don't outsmart yourself. Just do the long and tedious method. It'll work every time. 72% times 675,000 gives me $486,000 of revenue. But notice that this is costs to date. This is total costs as of this date. So what this really represents is the revenue that I could recognize to date. So really, this is revenue in 2015 and 2014. Therefore, to get the revenue from 2015, I have to subtract off the revenue I recognized in the prior year, and that gives me the amount of revenue that I can recognize in 2015. And that's why I like to label these things out. Now, you don't have to. It helps in your work, I think. You might not want to on a test when you're pressed for time. But see, it really clearly shows that this is the revenue that I could recognize between those 2 years. But I've already recognized $168,750. So I'm only going to recognize the amount in 2015 that is new revenue that I've earned by my incremental completion of the project. Now, this is the revenue that I recognize. The gross profit is going to be determined by taking the current year costs, $287,400, and subtracting that from the revenue in order to get the gross profit for that year, $29,850. That is my GP in 2015. All right. So finally, we have 2016. And the last year is always the easiest year. Why is it always the easiest year? Because you don't have to worry about calculating your percent to completion. You're complete, right? There's no more costs. So you're 100% complete, which means that you get to recognize 100% of the revenue. But of course, this is just the entire amount of revenue. So this is revenue from 2016 all the way back to 2014, so 3 years of revenue. Well, what is the revenue that we can recognize this year alone? It would be this amount minus the revenue you recognized in 2015 and 2014. And see how easy it is to grab when you have it clearly labeled. That just leaves me with the revenue that I would recognize in 2016 $189,000. And then again, subtract off the current year's costs to get gross profit, $170,100. And that gives me $18,900 of gross profit in 2016. All right, so a lot of calculations, a lot of rolling through this stuff. And like I said, the brute force method is definitely superior here. Even though it takes you a little longer, you got to be careful. So like what I was saying earlier is that you can't just say 25% versus 72%. Oh, okay, well, that increased by 47%. So I can recognize 47% of this revenue in 2014. I don't have to do this whole thing and back out revenue. I'm sorry. I can recognize 47% of the entire revenue in 2015. I don't have to do this whole long thing that Billy does. And that's just not true, because this is 25% of 600,000. This is 72% of 607,500. So you would be making an unfair comparison to say 47% of a total raise. Again, so just make sure you do it the long brute force method, and it'll also help you later on when we talk about what happens when these contracts turn unprofitable, when the estimated cost to complete becomes so high that we don't even earn a profit on the contract at all. There's ways to check yourself, right? All of this should add up to the contract price of $675,000. All of this should add up to the contract price less the total costs that we incurred on the project. We're just taking those items and divvying them up over years based on the amount of work we've done in any given year. Now, that was the percentage of completion method, and that, of course, requires us to be able to recognize revenue over a period of time. If we cannot recognize revenue over a period of time, we'll recognize it at a point in time, and in that case, you would want to use what we call the completed contract method. The completed contract method is rather simple. Revenue and gross profit are recognized when the contract is complete. Construction costs will be accumulated, but before construction is completed, there are no charges to the income statement accounts for costs or credits to the income statement accounts for revenues and gross profit. So we do not include income statement accounts in a completed contract method. So that means that those journal entries I showed you before, we would still keep track of billings, of accounts receivable, of construction in progress and costs. However, we just wouldn't do the income statement part until the final year, which means that we don't recognize any revenue in 2014, we don't recognize any revenue in 2015, and then finally we recognize all the revenue, $675,000 in that final year, and then we recognize the total gross profit, which would be $675,000 minus $607,500, comes out to $67,500. Right. So, like I said, simple to figure out once you've done the percentage of completion, but not preferred. Right. This is not preferred. If you can use percentage of completion, you should use that because it's a more accurate portrayal of accruals as we are finishing this contract. I'm going to look at one more thing here. It's called a loss on a profitable contract. So this is when we have a loss year. So we have the fact that current year costs are greater than current year revenue, but the total contract revenue, the price, the bid price, right, the amount we get paid for building or constructing this item is still greater than the total costs. So that's why it's a profitable contract, but we have a loss in a given year. No big deal. This doesn't induce any special accounting issues. And I'll just show you how to work it or when this arises. So the first year is exactly the same as before. I'm not going to rework it. I'll just go ahead and put down those numbers so that we have them to refer to. 168,750 and 18,750. So now we look at 2015, and we have total costs to date, right? Total costs incurred to date, 28,400, 150,000. So that's still 437,400 divided by the amount that we spent to date plus what we've estimated to complete. So then when I add these up, notice that the total costs to complete are different now in 2015 because the amount that we completed to date and then the amount that we have to complete, went up by a pretty good amount. Right? So this came out to 66.99%. And whenever you're doing these, round to the nearest tenth of a percent. So in this case, it's 67, because that is basically 67%, times the total contract price gives me $452,250. And this is revenue, remember, again, from 2015 and 2014. So in order to get the revenue I want to recognize just in 2015, I have to subtract off 2014, 168,750. Why am I subtracting revenue? I usually don't. Well, because there's some 2014 revenue in this calculation that I want to back out. And that gives me revenue in 2015 by itself, 283,500. Well, now, in order to get gross profit, we subtract off those current year costs, 287,400, and notice that this will become negative. That's all right. No big deal. Gives me negative 3,900 gross profit in 2015. So we have some negative gross profit, and that's just how it's recorded. Now, how is it recorded in a journal entry? Remember, the journal entry was costs of construction. That's our expense item. The cost of construction for this year, for 2015, were $287,400. And the long-term revenues are revenues from a long-term contract. In this case, were $283,500. Now, because we have negative gross profit, we're going to have a credit to construction in progress, which will just reduce that account slightly for the amount of the profit loss that we recognized. So whatever the construction in progress account was at, it would be credited now by $3,900. That's what happens when you have a loss year in a journal entry sense. Again, 2016, it's the year of completion. It's the easiest year because now we can recognize 100% of our contract price, $675,000. We would reduce this amount because remember, this is revenue from 2016 to 2014. We only want to recognize revenue from 2016 in 2016, so we subtract off the revenue we got from 2015 and 14. That leaves me with just the revenue from 2016, $222,750. $222,750. And then the costs, the current year costs, 215,436. Subtract those off, leaves me with $7,314 of gross profit in 2016. And then to check again, these guys should add up to 675, the total contract price. These guys should add up to 675 minus 652,836 in order for it to be the gross profit, because the gross profit would be this less this, the total gross profit. Would be gotten that way. And so that should be the amount of gross profit we recognized over all 3 years. So in the next module, or actually in class, but I'll post it as the next module, I want you to do this JJ Watt Corp. And I want you to go through, recognize the revenue and the gross profit on the contract, and also provide the journal entries for 2015 and 2016 so you can get used to filling those out and recording the construction in progress and the billings account and understanding how those two accounts work. So I'll start the next module, module 11.2, with the answers to this, and then we'll finish up with the figuring out how to do an unprofitable contract. So when the total costs have exceeded the total profit that the total revenue you expected to get on the contract.